if you take the assets by fee bucket, 0 to 10 basis point ETFs make up 60% of the assets, but only 16% of the revenue. If you go to the far end of the hot sauce bucket, over 80, they make up 6% of the assets, but 22% of the revenue. Well, where are you going to think the launches are going to be?
All right, joining me will be the one and only Eric Balchunas, Senior ETF Analyst at Bloomberg Intelligence. Of course, everybody knows who Eric is. He's simply one of the best in the business covering ETFs, certainly one of my favorite ETF analysts. Now, if for some reason you are not familiar with Eric, he co-hosts Bloomberg's ETF-focused TV show, ETF IQ. He co-hosts Bloomberg's ETF podcast, Trillions. Let's see, he's written 2 books, The Institutional ETF Toolbox and The Bogle Effect. My understanding is he actually has another book in the hopper. That one will be on crypto and crypto ETFs. And then you can always find Eric out on X tweeting about both crypto and ETFs. And I know I always say this, but I think one of the things that I most appreciate about Eric is he has this uncanny ability to coin new industry terms and metaphors. So he's actually behind a lot of the phrases people just toss around on an everyday basis. Things like boomer candy and the ETF terror dome, BYOA, right? Bring your own assets, portfolio hot sauce. He has a bunch of these out there. I honestly don't know where he comes up with this stuff. But my goal this week is to try to get something new out of him. We'll try to get a new industry phrase, which I think we have a pretty good shot of doing because Eric and I are going to go all around the world of ETFs. We are going to cover it all. And I have decided to give Eric the full hour on this podcast because every single time he joins me, like clockwork, we're always short on time. So you're going to get a full hour of us. And this should be a fun conversation with someone who knows the ETF space inside and out. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. All right, so let me now bring in Bloomberg's Eric Balchunas. What should I call you? Like the walking ETF thesaurus or something like that? I seriously don't know how you come up with these phrases that you coin.
Unlike you, I'm keeping my ETF title. Just saying.
I knew you were going to lead with that.
I'm all in on ETFs.
So for people who are
senior ETF analyst, or I guess you could say, it sounds fancy, but I lead the global ETF research team, which when I was in Asia recently, that's how I was introduced. That sounds pretty cool, but I'd say just ETF analyst, or sometimes I'll get ETF guru, whatever. I don't care.
And if people don't know what Eric is referring to, so we recently changed the name of the advisory firm that I operate. Most people know it used to be called the ETF Store. It's now called Novadius Wealth Management. And just so you know, Eric, the rationale behind that, this is a good thing. It's because ETFs have made it. ETFs are no longer any sort of differentiator. So I know you think it has something to do with my views on tokenization. It actually doesn't. It's that everybody uses ETFs now. They're table stakes.
Yeah, no, it's interesting. One of the people we interviewed for the crypto book I'm working on, we talked about the moment the ETF arrived and how huge that was. And this person was like, I don't want to give away who it is. I want to save it for when the book comes out. But they were like, my work was done here. Bitcoin won. This was it. Now Larry Fink can promote it. I can go on to other things. And I think that's sort of what you're saying with ETFs. But the reason I love ETFs and continue to just, um, really stand by them is that A, I want to be right. And I do believe they are the toughest vehicle I've ever seen. They are going to fend off all kinds of competition, and they have. The other thing is, every day is a new journey. Every day is a winding road, as Sheryl Crow would say. The novelty is through the roof. 4 ETF launches a day. It takes you all over the asset class world. Most people in their jobs have to be a mile wide, inch deep, or a mile deep, inch wide. With ETFs, you got to be a mile deep and a mile wide, or at least die trying. Do you know what I mean? And so that's why I love it. Like, even though I have the same job, like I write, I talk, I do the sit by a computer. The ETF industry keeps it real fresh and new and novel, and for that, I'm grateful.
I have found it much more difficult just to stay on top of everything occurring. I think I'm a quasi ETF analyst. I wear a number of hats with everything I do. I think you're in it, obviously, much more full time. it's tough. I mean, I really feel like we're drinking off a fire hose right now between new launches and you look at flows and some of the stuff we'll talk about here today. It's been difficult for me just to keep up with everything.
Yeah, it is. That's the fun of it, though. Um, there's occasions where something is wrote. In fact, in the book I'm working on, there's a chapter about ETF due diligence, and I'll be honest, that was the least inspiring to write and the least inspiring to read over when I was editing it. I'm like, oh my God, because I've done this so many times. You know, what is an expense ratio and bid ask spreads? It was necessary for this particular book because I'm talking to somebody who has an option now to buy Bitcoin ETFs to get exposure. So I have to go through like how to pick one. But that was a sign that like I have been doing this a long time. But like I said, the rest of the book is real fresh. I mean, there's a lot of stuff I'm just learning, and that's why I write books is to really completely get my head around something that I'm interested in. And that is there's no because if you have to write about it and put your name on it, you better know it. So I've been on a real deep journey in the crypto world, as you have for sure. And I feel like I'm maybe like a C student in crypto at this point. I'm much better than I was though, and they say you need about 100 hours, and I think I put in my 100. So I'm maybe I should get like a certificate or something that I speak fluent crypto or something. I don't know. We'll see.
All right, so we're going to dive into a number of ETF topics. Certainly, crypto ETFs are one of them. I thought, like last time, we should probably save that for later, or else it'll eat up all of our time, and we won't get to anything
Yeah.
else. But let me ask you this: but before we move on from crypto ETFs, do you find crypto ETFs as the most fascinating spot in the industry right now, or would you point to another area?
Oh, easily. Yeah. And not everybody on my team is into it. James and I are really into it. Athanasios and Andre and Rebecca. And they're just, well, Athanasios is borderline a hater. Where everybody else is in the middle, doesn't really care that much. James and I kind of have the bug. But for me, the reason I love it and it's so fascinating is that crypto brings you into Wall Street, geopolitics, the money, history, technology. It's fascinating if you let it be. But the bigger thing that I find so exciting is this clash of cultures and clash of worlds. This is the first asset, really, that has come from the underground grassroots and then was adopted by the institutional world. Normally, the big fish are using something and then someone democratizes it and lets the little people get access, like bonds and stocks, right? This is really interesting that this bubbled up from the people, and now the Wall Street world is trying to give the bigger fish access. And that means that you've got this collision of TradFi and DeFi. It's definitely a culture collision, and it's a generational collision. And I know this because now, for the first time, if I go to a crypto event, I feel old. Or when I communicate with some people on Twitter, I'm like, man, I kind of feel like the old guy now. And that is interesting to me. And the culture is also inviting. These are people who are excitable, but at the same time self-deprecating. Sometimes TradFi is a little too high priestish for me in many cases, throwing around the Greek symbols and, oh, you'll be sorry. It's almost like they're little too know it all. And I think the crypto has this inmates taking over the asylum feel. And I've always loved that, whether it's in music or comedy or anything. I really enjoy that sort of somewhat chaotic feeling of like the people who shouldn't win are kind of like winning. And so there's just multiple attractions for me that might not be attractive to somebody else. And if you look at the numbers, every time there's a launch, it's like the top of the year, if not top three. And then going down the line, you look at the flows, it's just breaking all kinds of records. Bitcoin in particular was the greatest launch in the fund industry, which is 100 years old. Not just the greatest launch by fivefold. The metaphor I use is Tiger Woods and the 97 Masters. If you're a sports analyst and you watch that, you can't think of anything else for 3 or 4 years. You're like, the whole golf, everything's changed. New generation, new type of golf. Like, he completely made people obsessed. That's how I feel about this. It's weird to me, people who aren't. Like, I've been traveling the world and showing these charts of like IBIT being the fastest to 100 billion, and like the next fastest was like 5 years later, which is VU. And then I show how IBIT is the top revenue generating ETF for BlackRock out of 1,000 ETFs, and it's 1 year old. And the next three on the list are 24, 25 years old. I mean, I was like, if I was in the car industry and I showed you that Ford put out this car that did this, the whole industry would be crazy. They'd be all like clamoring to put the car out. It's something about crypto that half the people just write it off as bullshit. And that's fine. But for me, I can't help but being I'm just totally obsessed by it. That said, I do have other things that go on in the ETF world. And so I'd say I'm probably like 50% crypto because of all the changes in the SEC and all this. There's a lot to go over. And then maybe 50% is on my sort of other things like Vanguard and gold and the 2X stuff. And, there's always stuff going on in the ETF world. So that said, crypto ETFs are only 1% of the asset. So you could argue I'm way too fixated on it. And I wouldn't push back on that. I probably am.
Well, let's talk more about that last point. So, if we were to put crypto ETFs aside, again, we'll come back to those here in a little bit. What does have you most interested in the world of ETFs right now? Where do you find yourself focusing the most attention?
You know, I, Interesting. Like, I suppose right now, probably all of well, okay, I'll give you the more sober professional answer and then the more like little like me being fascinated by crazy stuff. I think auto callables to me are probably the most interesting new category. I just put out a post that if you look at the Calamos auto callable ETF, it's came out in June. It's had inflows every week of its life. You never see that. I don't even know if iBit did that. Every week for 5 months straight, inflows almost every day. And Calamos is not a big issuer. This isn't BlackRock. Most people don't even know them from the advisor world. They're known for other things. They've gotten to ETFs maybe like 5 years ago. Anyway, this ETF is a very complicated ETF that uses option strategies to produce a 14% yield. And I won't go over exactly how it works, but we call this yield 3.0 or manufactured yield. Derivative, like ETFs that have big yields and the source of the yield is derivatives, is manufactured yield. Those types of yielding ETFs take in 80% of the flows, whereas income, like dividend ETFs, take in 20%. So there's this huge rush to manufacture yield. I mean, JEPI would be like the king of that. That's the equity income one. So this is I guess, an evolution on JEPI. It probably is a little riskier than JEPI in some ways, but like way less risky than yield max. But that whole area of like, give me some income, give me some yield, and you can find your perfect sweet spot for how much yield, for how much you give up in terms of risk. That is really fascinating. So I also hear a lot of buzz about auto callables. When I travel around, it's come up a lot. I've seen a couple filings. I feel like it's the early days of the buffer, when a couple of them came out and there's something new. But honestly, these have had even faster traction than the buffer ETFs in the first 6 months, 5 months. So that would be something that I'm watching and interested in. And that's part of our larger theme of Yield 3.0. That would be my like sober answer. And I guess my crazy stuff answer would be the leverage. I mean, 2x 2x, I call it the volatility barrier. These some of these issuers are really pushing the envelope and they're trying to outvol the next person. And they got an ETF at one point that had a vol of 350%, which the S&P is 16% or 15%. So we're talking like 20, 30 times more volatile than the S&P. It's a 2x quantum computing stock. And now they're trying to put 3x on that same stock. And I'm like, okay, at some point, we're just going to have like blowups be a regular part of life, or the SEC will say no. But that whole idea of like pushing the hot sauce, we call it the hot sauce arms race, is pretty fascinating, interesting to me. Now, I'm always interested in Vanguard and VU, and like VU's not going to have a record of 100 billion, but I guess suppose my last book was on Vanguard, and I really was in Vanguard world for like years. I find that like something that I know exists. It does its thing. There's nothing quite new there, but you can't deny the just studness of VU and that sort of low cost beta ETF bid that is just relentless. We call it the Vanguard put. That's also been fascinating. So there's a couple themes that are outside of crypto that we're interested in.
A couple of follow-ups I would ask you on that. First, with auto-callable ETFs and really options-based income ETFs overall, and then you mentioned the leveraged ETFs. I feel like this year there's been a lot more debate within the industry as to whether or not products like these should exist. Like we recently had filings for 5 times leverage, single product ETFs. I think I know where you stand on this, but I'd love to have you just elaborate on that because there's a lot of consternation. You have some of the ivory tower people in the industry saying these should not exist out there. They're bad for retail. They don't understand them. What's your take on that?
It's interesting. I guess there has to be a line somewhere, right? So I have no problem with 2x ETFs. I really don't. Um, I feel like if you are a health food fanatic, you're going to walk around and trash McDonald's. You probably think McDonald's shouldn't exist, but most people, not everybody wants to eat health food all day long. So I just look at these as like Jack Daniels and McDonald's. Um, if you think if you think they are sort of wrong or bad, that's because you like health food. Fine, but you have it's okay to gamble. It's legal to gamble. I could go to Vegas tomorrow with all my money. In fact, I don't have to go to Vegas. I could probably just use the internet and put everything on roulette, black or red, and lose it all in 1 second. At least it takes a little while to lose your money with these. That said, there are products that you will eventually lose on, probably. I mean, rarely. It's just sort of like going to the casino. You might win for a while, and you'll probably eventually lose. But look at it as ROE, return on entertainment. Did you have fun? Was it, again? Some people like to do this while the paint dries with their 60/40 because it's so boring as hell to watch something grow for 30 years. The key to investing, the most important thing in investing is compounding. It's magical. But the problem is it takes Buddhist monk like discipline and patience. And not everybody has that. So people like to fiddle around with some shit while that tree grows. And so what? I can't, I'm not an ivory tower guy. I can never be that guy. Now, if one of these ETFs doesn't track the thing correctly or they halt creations, I'm pissed. As long as it does what it says it's going to do, even if the swap contract price is a little pricey for like a certain 2x stock, um, that we point that out, but I still wouldn't judge it as being bad because that's what the swap would cost if you went to JP Morgan or someplace and got the swap anyway. But as long as the issuer isn't doing anything nefarious or halting creations, I'm fine with them. As you know, we have a traffic light system that's like movie ratings. We would call all these red light products, just know what you're getting into. But I do not think that we should ban Quentin Tarantino movies just because 10-year-olds exist. That's my take on it. And I know others disagree, and it's fun to like moralize on it, but I'm not that guy. And so I look at it now. Where's the limit? Should we have 5x? Probably not. The problem with 5x is you only need the stock to move like what, 20%? And some of these stocks are pretty volatile. We did a study and found that even 3x, you have multiple blowups already in the single stock world. So because 2x, you had one blow up in Europe already, the AMD 3x, sorry. So with 3x, you probably have a blow up every like few months. With 5x, you'd have a blow up like every few weeks. So when I say blow up, I mean like it goes up so much that there's a termination event. But also the swap people might not want to write swaps knowing that it could go down below 100%. So this gets into like, I don't know, maybe too far. So because then we get into should McDonald's sell heroin? So like there is a point where it's like, okay, well, McDonald's is fine, but like, yeah, let's not put fentanyl in the fries.
Yeah, I agree with that. I've always been, as long as the product is doing what it is supposed to do, the risks are properly disclosed, then I don't really have a huge problem with these products existing out there. I do think that investors have to take on personal responsibility as well. You can't just offload that personal responsibility to somebody else. So I think generally I agree with you. The other piece of this, and I've talked about this recently, is from an ETF issuer perspective. You coined this phrase, the ETF terror dome. It's tough to compete. And so if you're a smaller issuer, a spot that you can compete, a Vanguard free zone, a BlackRock free zone, are in these exotic products. And as you know, all it takes, you can be a small issuer, you launch a leveraged single stock ETF or some sort of options-based income ETF. And if you hit, it's the right company or right underlying exposure, that could be a lottery ticket for the firm itself. And so there's a financial incentive there for issuers to bring these products to market and keep trying. I think we're going to see more of
100%.
it.
If you take the assets by fee bucket, 0 to 10 basis point ETFs make up 60% of the assets, but only 16% of the revenue. If you go to the far end of the hot sauce bucket, over 80, they make up 6% of the assets, but 22% of the revenue. Well, where are you going to think the launches are going to be? Unless you're some like total on a mission Vanguard person, you're going to launch at the other end. If you're looking for, to get revenue, and it's a capitalist market, and the SEC approves it. If the SEC doesn't approve it, I wouldn't be like basically slamming it. So if it hits the market, the SEC approves it, it has a prospectus, it has all the disclosures, then it comes to a point where does it actually go out and like do good work in getting swap agreements, and does it track well? That would be what I was looking at. But again, we would just say, hey, look, this is high octane shit. This is like a power tool, so be careful.
The other story that you mentioned, Vanguard, we talked about VU. VU recently became the first ETF to cross over 800 billion in assets. It's had over $100 billion in inflows this year. And I was looking, if you look at the top 10 ETFs by inflows in 2025, let me just burn through these real quick. So you have VU, you have IVV, you have VTI, you have SPYM, which I don't know if you saw that recently. Ticker, yeah, okay, SPLG, yep. You have SGov, IBIT, GLD, and then QQQM, BND, and QQQQ. My question for you is, if you look at the VU, IVV, VTI, SPYM, and then the two Qs ETFs, that's a market cap weighted exposure, top heavy. We have a lot of Mag 7 exposure. Does that give you any concern? I mean, you and I always talk about, we're in, my approach, long-term investor, let it compound over time, just what you were saying before. Investors continue to allocate there, but does that cause you any concern at some point that the money just keeps going into these products?
Not really. I just because I looked into it, and if you take the Mag 7, which we'll call the biggest of the Mag 7, those are like the leaders of the whole market. They're responsible for so much of the returns. And you unpack them, there's 850 acquisitions between the seven of them. And some of these acquisitions are big. Some are big you never heard of, like a cloud computing company that Google acquired for like 5 billion. Then there's something like YouTube, which if Google spun out would be the 19th biggest stock in America. So when I talk to the tech analysts in Bloomberg Intelligence who cover these companies, they're very bullish. They're like, these are like small countries. Each of these companies could be like a 10 stock index. So that's why we said, if you look at the seven of them, you got to pretend there's 70 companies there. And when you do that, you realize you're way more diversified than you think. Now, is this an antitrust issue? Maybe, but I'm talking investing in ETFs and indexes. That's what we're at now. You want to debate antitrust? I hear you, and it probably is an antitrust issue, frankly, because these companies get so powerful. And what happens is any company that's like in the private world or in a small cap or whatever, and they're worth anything, one of these companies just buys them. So they're like the LA Lakers or something, where they're just getting all the best players from like college and like high school, and they're just absorbing them into the company. So you'd be an idiot not to own these, especially at the weight of the S&P, in my opinion, because the CFA brain that you've been taught will tell you to go rebalance into small, middle, equal weight, something international. I totally get it. But that is looking at these as like the old school tech stocks with no cash on hand. That's the other thing. They have so much cash. These companies are the market in a way. So I'm not saying you might want to take profits. Like if it goes up, okay, take a little profit, maybe allocate to small international. But the problem is these other areas, especially small caps, which had a great run in the 2000s. I just feel like so many, it's barren of rising stars anymore, because it either, if they're good, they get bought by the Mag 7, or they wait to IPO till they're big. So like the small caps is no longer a farm league of prospects, it's a dumping ground. And so the market, in my opinion, has some secular changes. Passive is blamed for this, but it's not, in my opinion. It's the growth of these mega diversified, almost holding company tech firms in Mag 7. That's the new thing. The sort of no more antitrust rules at all. Let's just let these guys get really big. That to me is the new sort of secular shift. Index, and by the way, if any of these Mag 7 were not good, active would sell them, and their market cap would go down, and they would have a less weighting in the index. The reason they run the index is because active loves them. And so if active loves them, I'm not going to question that. They have all the information, and passive is riding those coattails. So I have learned, and the more I have been around, I feel like, that midwit meme, the market loves to punish midwits. You got to be like the dum dum or the jetty, which is like, oh, good stocks are good. Like that's it, don't overthink it. And if you don't overthink it, you win. You'll beat all the overthinkers long term, in my opinion. I could be wrong. That doesn't mean there are going to be pullbacks, and there could even be like a year or two of bearishness. But like betting against these US stud companies with the smartest people running them that work like fucking 100 hours a week, and they've got all this cash and all the smartest people working for them. Are you insane? People have let their CFA go to their brain a little too much, in my opinion. And I get it because they're probably like, well, I have to do something different to like show that I'm a human who can beat the index. It's tough. It's an existential crisis for active managers for sure, because we looked at the data in the past year, only 20% of active managers beat the index. So it was even less than their normal 33. Why? They all were underweight tech because they were told it's, oh, this is it, that now we got to rotate, oh, rotate. Well, they rotated, and Mag 7 is up like, I don't know, 50% since the tariff tantrum, and they are trailing again. And so, like, these are the smartest people. So we always say never go full CFA. You have to look at the Jedi and the Dum Dum on the midwit curve and make sure you're thinking of them when you invest. That's, again, in our opinion, that's what seems to have worked long term. And so I don't worry about it.
But does anything change that? Like I think this year you've had international outperform large cap US.
Ugh.
We'll see if it's
Yeah, listen,
sustained,
the
but that's
people who
always
bring
the
that up, yeah, I got to address that. Okay, international had gotten their clock clean by the US for many years. US is up 50% heading into this year in the past 2 years. That's 25% in each year. You're only supposed to get 9 or 10. So it is like 2.5 over the average. This year it had a tariff tantrum, it goes down. Everybody, I know, every headline was like, market sucks, Trump's ruined everything, it's all going to hell. Every economist, market starts going back. They still try to get it to go down. They're like wish casting it down, goes up and up and up and up. So that just, it's a minor miracle. It's up 14, 15% this year in general, after it just returned 50% in the 2 years prior. So international's up a little more. Like I think right now, US, the Qs at least, is about to beat Europe year to date. But since the tariff tantrum, the Qs is up 50%. So I think that international beating the US thing is a little bit cherry picking. It's sort of like I don't know, like when the Dolphins beat the Patriots in like the mid 2000s in the regular season, it's like, okay, fine. Patriots are 13-3, they're going to the Super Bowl, whatever. Like you really want to like hang your hat on the Dolphins beating the Patriots in week 12? Fine, you can do that.
so you think it's like it's another mid-twit take, bringing up
It
international
is.
right now.
It's a
Okay.
midwit take. I agree.
Oh yeah, sorry,
That's
midwit. Yeah.
yeah.
Okay, so we've touched on flows. We touched on the parade of leverage single stock and options based ETFs coming to market. As I think about stories that are getting a lot of run this year, obviously another one is the multi share class structure, this ETF share class structure, which quite frankly, I'm a little bored with. Like, I'm trying to find an exciting angle to this, and I really can't. But I think this is going to be impactful to the industry. And so, do you have any hot takes on this? Anything that you find particularly interesting here?
Yeah, we use the meme or the metaphor from There'll Be Blood. When Eli asked Daniel Plainview about the bandy track, I can finally sell it to you, and Daniel Plainview's like, "Don't worry about it. It's already been had." And he's like, "How?" He's like, "Drainage, Eli, drainage." And that's when he goes into "I drink your milkshake." He says he put the pipe in here and he drained the bandy track from over here. This is what the ETF share class is going to do. It's going to drain the mutual fund share classes of their assets because everybody wants to move. And if you can move without a tax consequence, God bless it. That's what people are going to do. We know this because the Vanguard share class patent has been around for like, what, 20 years? And that's what people do. Did you know the Vanguard 500 mutual fund is at now flows the ETF inflows and the CIT inflows? So not everything's going to the ETF. Some goes to the CIT, but the point is, people are, when given a chance, and that's only a 1 basis point difference, by the way, from food to like it's 1 BIP, and they're like, yeah, let me switch. So I think in these active funds, if they like the manager and like, okay, this is great, I can get the manager for a lower fee and a tax efficient wrapper. Why wouldn't you move? There's no tax consequence. So I think DFA will lead the way. They seem to be like the real guinea pig here. And if they start to see success, I see others following. I just don't see it happening overnight. I think it's like everyone's going to dip their toe in the water. Then if there's like a couple people like DFA and Capital Group, you get a couple big ones, then it could be a little bit more like a floodgates opening. But I see it probably more as a trickle effect over 10 years. And all this is really just like what we knew was going to happen, just a slow move of mutual fund assets over to ETFs. The one caveat to watch out for is the tax contagion, because right now 75% of active equity mutual funds see outflows. That's a lot. And so a lot of those are going to have an ETF class. If you have outflows, it's possible the ETF gets hit with capital gains. Ben Johnson just put out his mutual fund capital gains report. And I think one fund had like 87% of its NAV return. I mean, there's some crazy stuff because outflows force you to sell, right? So if you're a forced seller, the ETF could get dinged with taxable capital gains, and that would tarnish the ETF's stellar reputation as being tax efficient. But I'm not sure anybody who's been an ETF person for years will care. They'll isolate that and be like, yeah, that's that mutual share class bullshit. I think most of the regular ETF people, it's like, okay, I'm just going to keep my ones here. But for those people who are doing the share class, I would try hard not to contaminate the ETF share class. But that's one thing to watch with that share class. But those would be my two general takes on it.
Somewhat related to this topic, any thoughts on Vanguard leaning more heavily into active ETFs? Because clearly they're going to leverage this ETF share class structure, right? They've been using it for index-based products. They're going to use it for active products. And if you look at the launches they've had over the past couple of years, there's been a greater focus on active from them. So I'm curious what you think about that. I mean, you literally wrote a book on Vanguard and Jack Bogle. Does that surprise you at all?
No, not really. I mean, I think, Vanguard is number one or number two in every category imaginable, right? But they're 19th in active ETFs, right? They just sort of missed the boat. And they're third in active mutual funds. So there's a disconnect there. And Salim Ramji helped launch active ETFs at BlackRock when he was there. So it makes sense he would come in and go, why aren't we doing active? This is a clear hole in the product line. Let's do that. We wrote a while ago and said they should definitely do active equity ETFs because some of their active equity mutual funds were seeing outflows. And we thought, well, the ETF could be like a way to stop that. Just, they had the same problem as most other people. So it makes sense to me. They also don't have to worry about like the cannibalization aspect because they're already low cost. So, although what's interesting is they're coming in these categories and they're not even in like the top 5 or top 10 lowest. So they are finding out this weird thing, which is the Vanguard effect has outrun Vanguard, and that's got to be trippy for them. Bogle would love it, but Vanguard, the company, is probably frustrated because they want to battle J.P. Morgan, and most normal people are ambitious on Wall Street. They're ambitious, they want assets, and they want to grow. Bogle was just total lunatic in that he wanted less growth. he would so in a way he would he was fine with Vanguard's active mutual funds. In fact, he launched many of them. But what he didn't want to do was grow. He was when they got. I remember I visited him and they had 4 trillion. He goes, "You believe we got 4 trillion in assets? What? Who? Why?" You're talking to a guy who wrote the book called Enough. He wrote a book called Enough, and now they have 10, right? So the reason he didn't want to be big was that he thought they would lose sight of every customer being a soul, a person, a human being with a soul. And like, he wanted to make sure that they never lost that. And when you get that big, you can tend to lose your focus on and even knowing who your customers are because they're all like numbers and stuff. So that's where Bogle would probably be fine with low cost active. But on the flip side, he would I don't he, I don't know if he would have put them into an ETF. Well, he wouldn't have launched ETFs to begin with, but he wouldn't have launched smart beta. Like most of the things Vanguard has done in the last 25 years, Bogle would not have done. But I personally would have. I think, in my opinion, kind of spreading out and making the whole industry cheaper is probably good for everybody long term. But he thought the company itself would be damaged by that by being too overextended and forgetting about the actual like it was like the sort of inverse Jerry Maguire thing where you're like, we need less customers and focus more on each one. This is the opposite. And this is part of just why I called the book the Bogle effect and not the Vanguard effect. I could have sold more copies, Nate, because hardly anybody knows who Bogle is, but everyone knows who Vanguard is. But I did that because I realized after that like Vanguard will eventually be run by normal, ambitious MBA trained people, but Bogle will always be the anomaly in physics. The total, just he's the oddball, not the company. And that has aged well. I'm so happy I named it that, even if it did limit my sales.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with Verify and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between Verify, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Markets are always evolving. The whole tactical U.S. ETF HTUS uses quantitative models to tactically adjust exposure to U.S. equities on a daily basis. It's about adapting with discipline. Learn more about HTUS and how it can complement your investments at wholetacticalfunds.com. Carefully consider the fund's investment objectives, risk factors, charges, and expenses before investing. This and additional information can be found in the fund's prospectus, which can be obtained by visiting wholetacticalfunds.com. Read the prospectus carefully before investing. The fund is distributed by Northern Lights Distributors, LLC.
A couple other stories I'll ask you about this year that just jump out to me. Private credit ETFs. As you know, this was a huge story coming into the year, but if you look at flows and assets, I think these ETFs have highly underwhelmed, at least relative to the hype. And so my question for you is, I guess, A, do you agree with that they have underwhelmed? And then if so, why do you think investors haven't been more interested in these?
I think they just aren't that interesting. For an institution, they understand why private credit can be interesting, I think. But for a regular investor, I just don't. It almost reminds me of like a permanent portfolio. There's certain things that play well in the institutional world that just don't play well in the advisor world, and I think this could be one of them. Because if you look at like something like CLOs, they were put in an ETF wrapper and they did really well because they really they had some good attributes that weren't available at that time in bond ETFs. But with private credit, you can kind of get the same yield in like a high yield fund. Like there's senior loans, there's multiple options to get kind of the same attributes. And so there was really nothing new. And like if you asked a retail investor to name a private credit, they couldn't. Now, private equity, different story. I think there it becomes sexy because they do know private equity, like SpaceX and some AI companies. Like they hear about these companies that aren't public from time to time. And when you give them something like that in an ETF wrapper, I think they'll respond. And we've seen that in XOVR, which is this guy, I forget his name. I should know his name, but anyway, I forget the company even. But it was like total indie company, like nobody knew this fund, and it just changed structures in about a year ago to a public privates crossover. It added 10% SpaceX, and all of a sudden flows started coming, and now has 400 million. And for a no-name product, that's really interesting. And it shows that there's probably some unmet demand for private equity in the ETF wrapper. So I've seen more private credit filings, but I'm surprised no one has just copied XOVR and been like, we're going to put these private equity stocks, not stocks, but companies in the 10 to 15% illiquid area. And then maybe even try the State Street move where they can maybe like say, well, Apollo will offer a market. We can actually go beyond the 15%. I'm surprised the equity side hasn't been pushed as hard, given that the market has spoke. They're clearly more interested in private equity than private credit. We'll see. The other thing is the private credit ETF was 70 bips, I think. And so for what you're getting, that confiscates a good chunk of what the income would be anyway. Maybe it needs to be cheaper. So there's a couple of things I'd like to see maybe tried again, but that's my thesis on why that was a lot of hype and it didn't take in too much. Seemed to underwhelm.
Yeah, I agree with you on the private equity side. I also think it's a much easier story to tell because there is the narrative, which is true, that there's a lot of companies that are staying private much longer, and the average investor can't get access to those. So if you can figure that out in the ETF wrapper, I think that's an easy story to sell. And some of these companies, SpaceX, we can go on down the line. They're interesting. They get a lot of headlines. I think there's a lot of buzz there, so it's something that investors want exposure to. Before we close with crypto here, any other ETF stories on your radar for this year? Anything jumping out at you?
Not really. Yeah, I'm pretty blank. I riffed off some of the most important things. The buffer ETFs is I was going through my PowerPoint that I just did in Asia. How about this? I'll give you international just because I just traveled into Asia, Brazil, the Middle East, Mexico, Europe. I mean, I was practically all over the world this year. And what I can tell you is that the events we do in these areas get bigger and bigger each year. And there's more and more companies interested. The exchanges are interested. Hopefully you can still hear me. This is like classic New York City where there's like police sirens every like 10 minutes. But anyway, I'm in a New York City hotel room. So there's a lot of excitement out there. I just say to people who are here in the US, just don't appreciate what you have, because in other countries, people aren't as educated on like what fees are. It's going to take a while. Like the US is so far advanced as consumers, like we are a consumer culture. It's amazing, forcing us into DC plans in the 80s and 90s. We're all so with it. Other countries, like they don't know they're paying 2, 3%. Like there's just unawareness. And so, but it is changing. Younger people in particular do not think the government's going to fund their retirement. And the ETF is going to grow as people get smarter. That's a good place to be, as opposed to the mutual funds, which require people being in the dark and not smarter, right? And so ETFs, you can tell like it's almost like pricks of light coming out, and each country there's more and more light coming through when I go out into these areas. And I think they always look to the US, what's going on. So in my presentation, I went over much of the stuff we just talked about. But I think the only thing I didn't that we didn't touch on was buffers, and buffers are just so valuable to the older investors. And so the buffer ETFs speak to what we call is like the new white space is your feelings. Buffers really are like a Xanax. You buy one of those and it's like your anxiety's gone. And then on the flip side, the leverage stuff is like Adderall. You're bored, here, take one of these. You know what I mean? So it's like, so I think there's this like push to like create new white space in terms of solving problems or changing moods, almost like a pharma company. And that is something that kind of blew some of the minds of the people internationally, because they're still trying to sell cheap beta and stuff. So they're like, I'm coming from the future and explaining like all the stuff that's going to probably happen in like 5 years. And it was just interesting. It's almost like a time warp when you go to these other places. Some countries further along than others, but just interesting tidbit there.
Yeah, I agree. I find that fascinating because, to your point, you've been immersed in the space for a couple of decades now. You've seen ETFs grow up, and so to go into these international markets and see where they're at, in some cases they are 15 years behind us, or 20 years behind us. You kind of know what's going to happen, and so you can already see, like you said, these glimmers of light and see how it's going to play out. That's got to be a really unique experience.
And I will say one thing they are fascinated by, which I just wasn't expecting, is Vanguard. There's something about that company that fascinates people, and I was told to put more Vanguard in my PowerPoint as I went around, especially in Asia. They are just fascinated by how that works. I'm not sure if but I also try to explain the Vanguardian investor, this concept of the VU investor who never sells, as Nick Majuli's book is called, Just Keep Buying. No headline and no market can get them to stop buying. And I try to explain to them this is a new phenomenon. It used to be you buy high and sold low, and you're an idiot, and that's the dumb money. Well, the dumb money, at least the Vanguardians, are now the smart money, because if you just keep buying, you will beat the hedge funds, you'll beat the active managers. And I analyze, why has that happened? And I tell them that I think these people have three truths they've discovered. One, you cannot market time, at least not consistently. So I'm giving up. Number two, they've gotten married to cheap beta. They have dated active managers over the years, and they finally found marriage material in VOO or IVV, right? And they're like, there's no better partner out there, so I'm not going to change funds. So therefore, I won't leave either. And the third thing is, I think they really do think there's a US exceptionalism factor, which is that our companies just kick so much ass, and there's really no reason to like rotate into international. Some people maybe tried it, or they already have a little slug of international that went up when the equities went down. So they're covered. Most portfolios would have a little sliver of international already anyway. And this is really powerful, because that's the ingredients that you need to be, in my opinion, the best investor, the one that will beat everybody else over 50 years or 40 years, even 20 years, even 1 year in some cases. And so I try to explain that. And this is where I give Bogle a lot of credit in my book for actually changing behavior. He solved the problem of the dumb investor buying high and selling low. He solved it by giving them something that you can get married to. and they're all happily married, and that has completely changed behavior.
All right, just a few minutes left here. I know you have to run shortly. The one thing Vanguard is not involved with is crypto ETF. So let's close with that. And I'm actually, here's what I'll do. Let me tee up something that you tweeted out a few weeks ago. I think this was from your colleague, James Seyfert, but it was that since the beginning of 2024, there have been something like 155 spot crypto ETF filings on 35 different crypto assets. And that did not include spot Bitcoin and spot Ether ETFs. And I'm sure there have been some additional filings since you tweeted that out. Again, that was a few weeks ago. So here's the question I'll have for you. How do you see investor demand playing out as these things start to come to market? We've seen a few come to market with Solana. We're going to have HBAR, Litecoin, XRP. How do you think this looks from an investor demand perspective?
I think for the most part, unless one of them gets red hot and has a shiny object moment, it'll be more for the people who know that world. I think a lot of actual crypto investors might like ETFs, either to put in IRAs or like it's just ETF can be easier. So I think they're for the core natives of that crypto world once you get deeper and deeper. But if like HBAR has a run where it's up 100%, you'll get looks from the regular people and the traders and maybe even advisors. I think most of them will buy a basket eventually where they're like, yeah, I just want to own the 40. I think S&P put out their digital 50. 5-10 years from now, that's what people will own. They'll own like the S&P or hopefully Bloomberg. We're trying to work on this in the index world. The Bloomberg 50 digital, and it will be like the tokens and the stocks and the DATs and all this, and we'll give you the full picture, and then you'll just be like, set it and forget it. So that's how I think that'll play out. The other thing is we don't know which of these blockchains is going to like really get the most business. They remind me of 90s tech stocks in that they really have no profit. They're just starting and like but they're all like got smart people trying to solve this problem, like create a new internet. And I don't know who Ask Jeeves is going to be or who Google's going to be. Unclear. Ether and Solana look pretty good, but who knows? You look at the top 15 cryptos 10 years ago, most out of the top three are completely different cryptos. So an index makes sense. I will say Bitcoin is special. I'm going to put that over here as like a completely special thing. I feel like Bitcoin is like almost like a magical creation, in that it was given Satoshi. He's like this martyr. Nobody knows who he is. It's almost like created as like a religion. It is truly decentralized. And the idea of creating something of value that the government cannot mess with, right? Like a Picasso painting, like a fancy car, like a Mickey Mantle rookie card, right? But it's accessible. All those other things are only for rich people to fight inflation. Bitcoin comes along and makes an inflation fighting asset a store of value that's highly accessible. I will say gold's pretty accessible too. So I think the two of them are going to fight over this sort of like accessible store of value for a long time. Bitcoin, though, has the benefit of being more portable, especially for people in other countries. They want to like leave a communist dictatorship or something. They can just cross a border with their seed phrase and they don't have to like worry about getting like their gold taken. So there are some unique portability issues with Bitcoin, but that's getting into the weeds. I think for most people, the fact that it's scarce, the fact that everyone says it has value, and the fact that the government cannot debase it or mess with it in a world where we know the government's just going to print money to solve problems as a sort of clever way to tax the population. And we know that voters will never vote for like less stuff. You have to think there's a good bull case ongoing for this debasement trade. It's just a question on gold and Bitcoin sort of battling it out to see who gets the share of that because gold obviously had a great year. The really old stodgy institutions still, I think, would use gold over Bitcoin. But as Bitcoin's volatility comes down, and it has been, it's probably like double gold, but it was triple gold a while. It's coming down. If it can get down to gold levels and has a correlation of a little like zero, if it can get down to gold, vol, and core, then I think you could have a moment where you people can actually realistically say that it will pass gold. But until it does, I think it has that hot sauce risk asset thing attached to it, which will ultimately turn off some of the bigger investors for the time being.
But it sounds like from an ETF perspective, let's just set Bitcoin aside and we know what it's done in the ETF wrapper. Sounds like you're fairly bullish on index-based crypto ETFs.
Yes, I think. But remember, there is a glitter, which is the uh, precious metals basket of gold, silver, platinum, palladium, and it has a billion. But that's like it's 0.5% of all the physical commodity assets. Gold has the lion's share. So I don't know. I think it depends on how much Solana and Avalanche and Tron and all this shit like ends up breaking through the mainstream and becomes part of our lives, or we see big companies and stable coins. Like if it starts to get into our day and day, I think people buy an index. But if it doesn't, it's possible those are really just real for local traders, similar to the way the Palladium ETF has been around for what, 20 years? And it might, what is that, 500 million or $1 billion? Like people do use it, but it's for a local niche audience. So I just don't know the answer to that. The more I research, and obviously you're a real fan of tokenization, if we do go into a world where we have digital assets, then definitely a basket of those cryptos will be very big, because people will be like, yeah, this is the new internet. This is the new web. I need to own this. We'll see if we get there.
Before I let you go, Philadelphia Eagles Super Bowl. How are you feeling about
Hold
that?
on. You're not gonna. So do you want to just you're not gonna counter on the tokenization? I
I'm
need to
not,
hear
because I
you.
feel like if we go down that
Ah,
path, that's a
yeah, we
whole
have no
nother
time.
hour. We don't
Okay,
have time
listen,
to do
we're
that.
gonna have a
Yes.
part two. Maybe I'll have you on, and I'll basically ask you why tokenization is overhyped. Uh,
I love it.
it's not.
Because yeah, there's so many threads to pull
I
there.
know. I'm not bearish. I'm not bearish the way I was DI. I just think right now it's a niche case. If you tokenize VU, I think you get to digital asset people and emerging markets. But the blob of money is not going to leave VU. So I think tokenization actually helps spread ETFs to get to people in the platform they like for now. Now we'll see if we all, us boomers, I'm not a boomer, we're Gen X, but we get called boomers by the crypto people. If we all convert to digital wallets, then I would be more inclined to think tokenization takes over. It's tough to see like digital wallets replacing Schwab, but there's a lot of energy in it and interest behind it. So I'm much more open minded than I was with DI.
The question I always ask you on this is, do you think ETFs are the final investment wrapper, that it will never be better than that? That's always my
Well,
high level counter.
when I've been traveling, a part of my PowerPoint is like, here's why I'm not bullish tokenization in the short term. I used to say you can roll out of bed, but I don't even anymore. I can say you can literally wake up in bed, grab your phone, boom, boom, and you're going to own any asset in the world for almost no fee in 1 second. It is tough to disrupt that. So I don't. That might be the end game. That is investor utopia. I'm not sure unless you can think it. Unless I can just think, hey, I want IBIT, and it like maybe Elon gets like this stuff linked to our brain, and I can just think about it. That might be disruptable. But at that point, I'm just not sure how you disrupt that. It would be like you and I getting together and be like, how can we disrupt Amazon? Amazon, you just boom and you own it. Like I'm not sure what. I just don't see how you're going to make life better with a token in that case. So I just say ETFs are actually tokens, but with the benefit of being regulated, right? Coming from these big brands, the creation redemption process involves all of the sort of back office of Wall Street. Just seems like it's actually a better, more anti-fragile version of tokenization. But again, that in the bed scenario, until you explain how my life's going to get better, because they say in order to disrupt something, it can't just be 1, 2% better. It's got to be like 20, 30, 50% better to get someone to shift. So I don't see it.
All right, we're gonna have a full debate on that. Eagles, give me a Super Bowl prediction.
Uh,
Are they going to make
ooh,
it? And if they do,
a
are
lot
they
of
going to
it
win?
depends on AJ. It's all these diva wide receivers, Nate. AJ Brown. The year we sucked and lost to Tampa in the first round, AJ Brown went full diva, and yet last year he was real in he was had good spirits. This year he's kind of going back and forth. So in my opinion, if Jalen Hurts can just feed AJ the ball consistently and keep his diva emotions subdued, I think we can go all the way. But there's something happens with AJ. He starts to get the team out of sorts, and that's a variable that's real. But other than that, we have the talent and we show we can win, and so I'm pretty confident. But not again. There's that one. It's like that's the tail risk, Nate. How about you? How
All
you
right.
feeling about the Chiefs?
Chiefs have to make the playoffs first. It's not a given this year, but I'll say what I've told you for the last several years, which is if they get into the playoffs, you have to kill Mahomes. And we saw it last year, right? Because Chiefs barely won like 10 games. They were all one-score games. They ended up on the right side. Everybody thought they were vulnerable. Obviously, the Eagles showed that in the Super Bowl, but a lot of people didn't think the Chiefs would even make it that far. And I think as long as you have Mahomes, as long as you have Andy Reid, and those players, they're just going to be a tough out. And if you think about the teams that they would have to go through in the AFC, they're in Buffalo's head big time. Buffalo can't beat them in the playoffs. I don't trust Lamar Jackson in the playoffs. I don't think Baltimore's going to be there. Maybe New England looks a little bit better, but they haven't been there. Daniel Jones at Indianapolis, are you really going to put your faith against him, against Mahomes in the playoffs? I just don't see who it's going to be that drives the stake through Mahomes' heart, and that's what you have to do. But I'm hoping for another Eagles Chiefs Super
fair.
Bowl. I want a rematch.
It's good TV.
So,
I know. I bet you do. I did, and now I feel satisfied.
Hey, I
anyway.
like the sports hot takes. Always love your ETF hot takes, Eric. Nobody covers the ETF space as well as you do, so I appreciate your time. Thank you for joining me.
My pleasure, Nate. Talk to you later.
That was Eric Balchunas, Senior ETF Analyst at Bloomberg. That'll do it for this week's ETF Prime. I want to thank one of our sponsors, Aberdeen Investments. If you would like to learn more about Aberdeen Investments ETFs, you can visit aberdeeninvestments.com/active-ETFs. Next week, I will be joined by Paul Bayaki, Chief ETF Strategist at SS&C Alps Advisors, another tremendous industry resource. And we're going to cover a number of ETF topics and highlight a few Alps ETFs as well. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.